Hello, this is Dave, and welcome to Equities Story. I'm with the great Wolfie, and this is obviously just a general share advice and not personal advice, as per this disclaimer. And this is obviously TradeWatch, not Ask the Analyst, but it's the same disclaimer.
Good start.
Wolf,
Friday.
where's that building, Smarty Pants?
Oh my God, that looks like Reichstag or something.
Mate, it's your own country. You don't even know. What do you mean?
The pictures are so small that I can't see pretty
What do you mean?
well.
It's not that small.
I've got a little screen of you right in the corner somewhere, so I can't really, your head is so big that I can't actually see much behind you.
I'm out. What is it? There you go. Look,
okay. Yeah, I know exactly what this is. This is in Krakow. This is the main, like a little thoroughfare in Krakow Square.
No, it's not. It's in Sokopan.
Oh, is it?
Yeah.
I've got no idea. Okay, I know my country very well.
Well, this is in Sokopan.
Zakopane.
Yeah, it's nowhere near. It's
But
not.
Doesn't look like Zakopane. Are you sure? Because that doesn't look like. I've been there many times, Dave. It doesn't look like.
Okay. No, you're right. It's in Krakow.
Thank you.
You're right. So tell me something. A nice little square, is it, in Krakow?
Yeah, very. It's one of the largest public squares in Europe. Yes, it's massive. Okay. It's beautiful.
There's only one restaurant there, though. Is that because no one there?
Oh, no, they've got loads of restaurants. This is the building is right in the square, in the middle of the square of Krakow, old town, right? Which is surrounded by, of course, other shops and little restaurants and so on. But this is like a little touristy spot where you go and buy souvenirs.
Okay, thanks, Wolf. Anyway, looks very nice. You know you're Poland, don't you?
Oh, I've been out to Krakow many times as well. So the touristy stuff.
All right, Wolf. We got some things to talk about today.
Yeah, we do. Let's start with some of the announcements this morning. And look, do we want to start with announcements? Or do you want to just make a rant on what's going on in the US? Which one would you like to go with first?
No, let's talk about ANZ because it's.
Look, I think there's a theme developing here. While the banks are reporting very well, they are obviously referring to the outlook and the second half and so on, where things are deteriorating for them, right? Because we're heading probably down a lower growth and possibly recession. So that's not going to help the banks. The banks don't do very well in recession. So that while maybe they can squeeze out a few more margin out of interest rate rises, there's obviously a flip side to it as well, right? So the actual outlook is probably what's driving these things, because yesterday NAB, today ANZ actually reported pretty well, but it's the outlook that's probably killing them, talking about raising provisions, all these a lot of things that potentially is spooking the market. So you think to yourself, where to the banks? I mean, you can't love them in the good times, you can't love them in the bad. What is going on, right? So I think, again, you've got to look at them as just dividend stories. And when you look at the dividends, they're excellent, right? So that's maybe what you just got to always treat this as. Nothing more, nothing less. Just a dividend story. And maybe set yourself a target of, okay, 22 maybe, right, is my last line of defense, 21 maybe, whatever, and just keep sticking in there, picking up those dividends. And the best time to buy it is when they're pretty low, when they on the nose like this. So,
Wolf, are they holding their dividends?
Yeah, they're actually increasing the dividends, Dave. They've increased the dividends. So, for example, I had a look at ANZ's. First of all, ANZ is trading on about less than 10 times, right? So it's pretty cheap, traditionally, historically. And I think the dividends are around 7%, right? So that's very good. That is very good on current prices. So you'd be looking at, okay, 7%, 9% historically, 9 times earnings, historically very, very attractive. You'd buy it and just sit there for 5 years and just collect the dividends. That's all you got to do, really, with it. But it's always going to be boring. It's always going to go probably sideways, have these little moments here and up and down, but generally speaking, not to do much at all.
All right. So as a dividend play, happy to hold.
Yeah.
Macquarie.
Mm-hmm. I very much like that result, Dave, today. This is a full-year result. And I tell you what, let me just read out something to you because this is quite interesting. So it's down slightly today, which is surprising because I had a look at the expectations from all the brokers out there. So I'll tell you what, Macquarie came up with a basic earnings per share of 100 sorry, of 13.54, and they've come out with let me see, I'm just looking at dividends of 7.50, right? So look at these brokers. They come up with their EPS forecast of 12.72, so that's lower. So obviously they've smashed their expectations. Morgan Stanley 12.52, smashed their expectations. Ord Minnett 11.79, smashed expectations by $2. Morgan's 13.08, the closest one, still beat their expectations. Citigroup 12.83, smashed their expectations. Dividend wise, smashed all their expectations. So all the things that have come out today was really good. It's probably maybe the outlook, or maybe again
I'm just reading it here. The CEO is saying against a less certain market and economic backdrop.
Yeah, but they say that every single time. That's what they say, right? They say it every single year, every single quarter, say the same thing over and over again. We're conservative in our assumptions. You know, we're looking at growth, but you know, all depending on this is the same thing. I tell you what, there's one slide in there that actually paints a very positive picture, because it was actually a tale of two sides to this business today. So Macquarie, their main driver for the huge result today was the commodities trading space, right? But if you look at on the presentation, one of the slides in there, they're talking about the short-term outlook. And they're talking about, again, commodities, you know, hard to predict what the commodity is going to do, but they're expecting still a pretty good result in next year. But the other two business units, banking unit, and I think the Macquarie Capital, they're saying it's going to pick up, right? If that's the case, and they were pretty subdued this time around, there's your growth again, Dave. So for me as a keeper, you know, again, I don't think that market understands. I don't think they've got a clue what Macquarie Bank is about, really. So for me, keeper, possibly if it's weak, you probably buy it, because it's, again, 4.5% dividend yield. It's actually trading on 13.4 times. It's very cheap for Macquarie. It's almost treated like a bank, but it's not, right? So it looks good. I think that this should be at least $200 plus.
All right, and Macquarie holding up very well on the monthly, and that's what it's all about. I mean, I'd like, you know, these are just certainly the bank's dividend stock, although it's not doing very well on the monthly. It just trades really, it just range trades, these banks do, don't they? Good, but as dividend plays, happy to hold.
Yeah, absolutely. I mean, these banks are very strong. They are nothing like American banks. You know, they are well positioned. I mean, is there a risk? Of course there is. In anything there's a risk, right? Because if contagion spreads in the US, and we'll talk about it in a moment, you know, we're going to suffer as well. And if there's a recession, banks will suffer. But generally speaking, they are probably the best positioned banks globally, even.
All right. How's SQ2 or SQ doing?
Not bad. I think I looked at the US. They come up with a quarterly. It wasn't too bad at all. And I'm just having a quick look after market. So just give me 1 sec, Dave, and I'll quickly tell you what they're trading after market. And they're up 2.5%. So obviously not bad result for SQ. But you know, I wouldn't be touching this. This has got a short attack at the moment on it. You know, they're talking about it's I think one of the business units. There's maybe some money laundering. It's not quite. I wouldn't be touching this. So even for a trade, Dave, now I'm really put off. So leave it.
Okay. IPD.
Yeah, look, so you know, it's huge rises to and we spoke about it. So why it's rising? You know, it's starting to get some revenues, yes, but it's also getting some recognition for some new products, also new devices that they just come up. So today announcement, I think pretty much is one of those sell up the fact, right? Because they've got another FDA approved device out there. So potentially it's on the up, but it's way too early fundamentally for me. I need to see, you know, at least probably 12 months worth of quarterlies for me to get excited, but you never know. It could be a tradable stock one day.
Apple.
All right. So Apple really smashed expectations actually, Dave. So almost, I think some funny memos at the end of the, on some of these sites talking that Apple saved the day pretty much, or saving the world with its reporting. And, you know, it was actually very, very good. They're up 2.5% after market. So potentially, again, it's a decent story to probably hold and own.
CMB?
Yeah, look, very good results today, but over 100 meters at over 1.5% copper. So, you know, this Greater Duchess is growing, it's getting better. So probably one of the better explorers in a copper space. So if you're ever looking at playing copper, which at the moment, unfortunately, is a little bit weak, you know, this could be the one to probably look at.
We're going to talk about gold now. A bit of a warning. Fortescue looks like it's a sell. That dividend, you know, you're looking at iron ore prices going down below 100. Possibly those dividends are going to could get cut. So there's risk here, Wolf.
Yeah, there is, and one of the big brokers come up and saying they're expecting that the median price for iron ore will be just under 100 for next year and $70-something for the following year, Dave. That doesn't sound good for some of these iron ore players. So potentially maybe that's some of the weakness you see today. Yeah, of course, you know, you don't never know what's going to happen in 2 years' time, but you know, $120, $130 is elevated levels anyway. So potentially you could see this trading at 100 and FMG probably struggling.
Yeah, and if they're giving it what about a 10% div at the moment, that, you know, if it went to 70, that could easily come down to about 5%, right?
Yeah, or even lower, absolutely 5 or 4%. Like that.
Okay.
So just be wary and understand, right? If you aren't having this for the dividends, you might have held it for a long time. You just might have a little bit lesser return out of your FMGs that you've had previously, which was a cash cow.
All right, now Wolf, overnight, let's look at CNBC. Just issues with more American banks and more. There's so much more worries there, and you know, yeah, we talked about it. The commercial property issue they've got. A lot of banks are leveraged to it. There's a lot of you know, this cheap credit that's been around the world. A lot of banks have over leveraged. What's your take on this whole situation?
Yeah, look, I'm getting more nervous by the day, I have to say. So that this contagion is starting to spread. So it started with SFB, then Signature Bank, then you know, a couple of others in there. Now we've got another one, and now there's a bit of a run on some of these banks. And you know, unfortunately, it's almost like a self-propelled problem where the shorters get on that because they know it's easy money to be made. It spooks the actual investors plus the depositors, right? So they pull the money out, and that's causing all the problems. It's the money that's just leaving the banks, which means the assets now are dropping below the actual debt levels, which means that on paper they're insolvent, Dave. That's the issue. So what do you do? What do you do with this sort of thing? I mean, one of the key, I think, things by all the commentators in the US saying the deposit should have been insured in the first place. They weren't. The first couple of banks, they obviously, you know, there was a bit of a bailout by the FDIC, but saying that they can't keep doing that for every single bank. So what do you do? And you know, it's one of those catch-22 situations because, like we just said before, low interest rates pretty much, you know, spurred all these cheap loans, you know, lending to real estate, you know, all those sort of problems on the cheap debt, right? This is what happens. So now interest rates go up by the Fed, they get caught out. I mean, maybe obviously they weren't very well as well, taking too much risk on, whatever, didn't protect themselves. Again, problem. But now, you know, they've created the problem again where for the Fed and everyone else globally, inflation is more important than the banking problem, right? So they're looking at that first, and they're pretty much killing the thing. So, you know, potentially what you could see is interest rates going up, the banking crisis gets bigger and louder and problematic, and then they have to go, okay, hang on a second, we can't keep going that, which could potentially also spell that inflation will probably drop as a result of this banking crisis because everyone's going to be spooked and probably under the bed sucking their thumb. So potentially you've got an issue, double issue, and what does everyone do? What does the Fed do? We'll see. But it is scary and it is problematic and high risk that we're coming up to.
I know what I'm doing. I'm buying gold right now. So, and
that's the beauty about, at least there's some green, and that's gold. Absolutely.
Look at that. Look at evolution. We talked about that one. Hasn't had catch up.
If you haven't bought it, it's not too late. It looks good.
We're going to prove to you not too late because I'm going to put it on as a trade today.
Yeah, I think even the fund might be buying some today. We can't resist that chart.
Okay, well, we're going to get in before you, mate.
Go for
Well,
it. I'll do it into the day. I'll do it into the day. So you guys go for it during the day. You know, I'm just going to slightly creep in there at the end of the day.
Wolfie, on that note,
Yep.
we are live in about an hour and a half.
Mhm.
Not too much to talk about, but nice little trade. And we're going to put evolution on.
Yep.
It's most probably is on, but I'm just going to put it on again because I think it's looking like the place to be, and we're going to be very, very careful at the moment. And what does that mean?
Mhm.
You sell below the water level, everybody. You sell. You
Yes.
don't risk your money unless it's maybe a dividend
Correct.
stock. Okay.
Correct.
You
Correct.
know,
That's the thing, Deb. I think, you know, the more we go through all these cycles and trading, and when they drop below the water levels, you know, how many times have we not sold and then we're kicking ourselves for not selling, right? So I think that the more you do it, surely you got to change your ways of trading if you're not doing it.
all right. Well said, Wolfie. And I'll see you in about an hour and a half.
All right.
See you, mate.
Thanks,
Bye.
guys.
Bye.